Your credit score is one of the most important factors when qualifying for a mortgage. Your credit score ultimately determines what loan product you'll use and what your mortgage rate will be. Did you know you can check your own credit and it won't hurt your score? You can, and in this video, I will tell you how. I will also tell you how you can fix any errors or mistakes, how you can get your credit score, what's even in your credit score. We'll discuss how your credit score impacts your mortgage rate, what you should do with your credit once you start the home buying process, and I'll actually answer if having multiple lenders pull your credit impacts your credit score. Feel free to use the chapters of this video to jump around to the section that you are most interested to learn about. When you check your own credit, your credit pull is processed differently than when a lender does it. And you can get a free copy of your credit report every year from the 3 major credit companies, Equifax, Experian, and TransUnion. So here's a breakdown how you can check your own credit. Get a free copy by visiting annualcreditreport.com. Call this number on the screen, or download and complete this form and mail it to the address here on your screen. I'll link this form in the description of this video. You can request a copy of your credit report from all 3 credit bureaus at the same time. Or here's a trick how you can monitor your credit throughout the year by having one of the 3 credit bureaus pull your credit every 4 months. You're entitled to a free copy of your credit report from each of the 3 major credit bureaus every year. So by pulling it separately every 4 months, you're going to cover yourself for an entire 12-month period. And by doing so, you can monitor your credit throughout the year at no cost or no impact to your score. Now, once you have a copy of your credit report, you want to review it carefully. Check your report for errors. The Consumer Financial Protection Bureau has a credit review checklist here, and I'll link it in the description of this video. Credit reports contain a lot of personal and financial information. They can have mistakes. And if they do have mistakes, you are likely the only one that can catch them. If you find a mistake, contact the credit reporting agency and the creditor. Explain what you think is wrong and why. It helps to contact both the credit reporting agency and the company reporting the mistake. File a dispute with a credit reporting agency and directly with the source reporting the information. Include any supporting documentation because there are certain cases where the creditor is not required to investigate. Now that you've reviewed your credit and fixed any errors, it's time to get your credit score. Your credit card company or other lenders might provide your credit score on their monthly statements or on your account online. You can even talk to a nonprofit credit counselor or housing counselor. They can often provide you with a free credit report and credit score. They might also help you review them. You can also request a copy of your credit report with credit score from services like myfico.com. But keep in mind, some of these services have subscriptions. So be sure you know what you're signing up for and how much it will cost you. If you're ready, you can even call your local and trusted mortgage lender, and they can pull a copy of your credit report with credit scores for you. Some loan officers might even be able to review the credit report with you and give you tips how you can improve your credit score. So now let's discuss what is a credit score and how does a credit score even work. Credit scores are basically a prediction of your credit behavior, how likely you are to pay back a loan on time. Factors that are typically taken into account by credit scoring models include your bill paying history, your current unpaid debt, the number and type of loan accounts you have, how long you've had your loan accounts open, how much of your available credit you're using, new applications for credit, and whether you've had any derogatory credit events such as debts being sent to collections, foreclosures, or bankruptcies. This information is run through a mathematical formula or algorithm called a credit scoring model, which creates your credit score. And you don't have just one credit score. Each credit scoring model depends on the data used to calculate it, and it differs depending on the scoring model, which in itself may be dependent upon the loan product the credit will be used for, the source data used, and even the day the score was calculated. Usually a higher score makes it easier to qualify for a loan, and it may result in better loan terms and interest rates. Most scores range from 300 up to 850. Companies will use your credit score to decide whether or not they're going to offer you products like credit cards, auto loans, other loan products, and even mortgages. They can also use them to screen rental and insurance applications. Now, if you're new here, my name is Tim Kelly. I'm a loan officer right outside of Washington, D.C., and the purpose of this channel is to help you manage your mortgage and finance your real estate goals. So when it comes to determining your interest rate, your credit score is one of the most important factors. Simply put, the higher your credit score is, the lower your interest rate will be. This is because with a higher credit score, lenders lenders see you as more financially responsible and less likely to default on any loan they give you. A lower credit score, on the other hand, may result in higher interest rate, meaning you'll pay more over the life of your loan. It's the lender's way of managing the risk. So improving your credit score prior to applying for a mortgage can save you thousands of dollars on interest. When getting a mortgage, credit scores often fall into several different tiers. For example, excellent, good, fair, and poor. If your credit score is 740 or higher, you're considered to have excellent credit, which is going to get you favorable terms and interest rates. A score between 700 and 739 is good, but you may not get the absolute lowest rate. Fair credit falls between 620 and 699, and anything below a 620 is considered poor. As I mentioned in the Navigating Interest Rates and Points video, your score will directly affect the mortgage rate you get. So the higher your score, the more affordable your mortgage will be. If your score isn't where you want it to be, don't worry. There are ways to improve your score prior to applying for a mortgage. Start by paying down your credit card balances and making sure all of your bills are paid on time. Even a few months of consistent payments can have a positive impact on your score. Remember, it's also a good idea to review your credit report and fix any errors that may be dragging your score down. In the first time homebuyer mistakes to avoid video, we talked about getting pre-approved early and how important it can be. Use this additional time to boost your credit score and get a better rate. If you're finding it hard to pay down your credit card balances, try calling the credit provider and asking for an increase in your credit limit. Do not close any accounts that you pay off. Keep them open. If you close them, you will lose all of that credit history. Now, during the pre-approval process, lenders will pull your credit to check your score and see how much debt you have. This helps to determine how much they can lend you and what your interest rate could be. A higher credit score will give you more negotiating power and let you borrow more. As it shows lenders, you're more likely to make your payments on time. If your credit score is on the lower end, don't worry. Your lender can still work with you, but your rate and loan options may be more limited. Check with your loan officer because some lenders and banks could have overlays, but the minimum credit score needed for conventional financing, that's a Fannie Mae or Freddie Mac product, would be a 620. With FHA, you can have below a 580 credit score, and VA and USDA financing aren't very clear about the minimum credit score, but the higher your score is, the more likely you're going to get approved for those products. Also, check with your state and local housing agencies to see what their minimum credit scores are for any programs or grants that they offer. For example, here in Virginia, the minimum credit score for a Virginia housing program is a 620. Once you start the home buying process, it's important to maintain your credit carefully. Avoid taking out any new debt like an auto loan or credit card because it can have a negative impact on your credit score and ultimately jeopardize your approval for your mortgage. Keep paying your bills on time and try not to use much of your available credit. In the How Much a House You Can Afford video, we talked about how your debt to income ratio can impact your mortgage. Keeping your debts low and your credit in good standing will help ensure a smooth process from pre-approval to closing. Now you have credit and you've worked hard to maintain or improve your credit score to do things like buy a home. Don't be afraid to have the mortgage lender you want to work with pull your credit. A single credit inquiry will have little impact on your score. Now, the credit scoring algorithms understand that you're going to shop around for the best rate on things like a mortgage, and they won't hurt you for shopping by having multiple lenders pull your credit. For the most common scoring models, having multiple mortgage inquiries within a 30-day period have no effect on your credit score at all. And multiple mortgage inquiries within a 45-day period are treated as one single inquiry. I'll link this article from the CFPB about having multiple lenders pull your credit in the description of this video. And if you found this video helpful, check out some of my other videos. Check them out. You might find them helpful.